When you're interviewing an investment manager, they should be able to articulate an investment philosophy to you that makes sense. Severin Investments, my firm, is a top-down portfolio manager, and that means we look at really broad things and then narrow it down when we're making investment decisions in your portfolio. Practically, this starts with looking at what's going on in the economy and making decisions about your asset class weightings first. Deciding how to weight your portfolio's asset classes is the biggest way that we can mitigate risk in your portfolio. Allocating your portfolio to cash or commodities, fixed income, which is bonds, or equity positions plays a huge role in how much risk exposure and upside potential you have in your portfolio. On the broadest level, asset classes are basically bonds versus equities versus cash, but we also look at, your large cap growth versus large cap value stocks, mid cap growth and value, small cap growth and value, international emerging markets, and the various fixed income asset classes as well when we're making those asset class decisions in your portfolio. Again, this is the biggest way that we can mitigate risk for you. Then we move down into sectors, and there are 11 sectors in the economy. Sectors are really broad industry categories like technology, communication services, healthcare, financials, etc. All the sectors we first weight in the portfolio equal to what the market exposure is. Then we go in and we over and underweight those sectors by really no more than 1 or 2%. This allows us to take advantage of things that are working well with the economy right now, underweight things that are performing poorly without substantially increasing the amount of risk in your portfolio. Nobody actually knows what's going to happen in the world from day to day. And if you're totally out of energy and energy just starts taking off for various reasons, then you're just out of luck. If you're a little underweight in energy, we can build that position for you and help you take advantage of the changing market climate. Other than just sectors, there are actually sub-industries or subsectors in the economy. For example, in technology, a subsector that's really hot right now is semiconductors. That's where all the innovation is happening in AI, and that's where you'll find the really exciting stocks like NVIDIA and Taiwan Semiconductor. But also hardware is a really good area of technology too. That's where you might find data centers or companies that make servers. And so you want to make sure that you're getting exposure to the subsectors that are benefiting from what's going on in the economy, not just the sector overall. That's going to help you improve your risk-adjusted return and take advantage of market trends. From there, we finally get to individual security selection. And when we're choosing individual securities, we never invest more than 3% of your portfolio in any one stock. We just don't think it's necessary to take on concentrated positions in your portfolio in order to achieve great returns. And we can get you better risk-adjusted returns if we have more positions that are smaller portions of the portfolio. We can spread it better across sectors and subsectors that way, better diversifying your risk, and more finely tuning the portfolio. When we're looking at individual securities, we're really focused on fundamentals. We want companies that have strong balance sheets, really great income statements that have hopefully positive earnings, but if they don't have positive earnings yet, we really want to see the potential for earnings growth going forward. Even in companies with strong earnings, we want to look at those forward estimates and see how they expect their company to grow, particularly in our growth-oriented portfolios. We're trying to find companies that are growing for you, not stagnant. Now, if you're in our current equity income portfolio, which is more dividend-based, we focus on different fundamental qualities of a company, such as how long they've been paying their dividends, whether they increased their dividends, their dividend payout ratio, which is the percentage of their net income that they pay out as dividends to their shareholders. Some of these other fundamentals make companies better for different investing styles. But in a growth-oriented portfolio, we don't typically look at the dividends too much. We're really focusing on the growth potential of the individual stocks. Managing portfolios this way, using individual securities, taking this top-down approach, helps us ensure that we are really effectively mitigating risk in your portfolio, getting you exposure to all different areas of the market, and ultimately it helps us give our clients better risk-adjusted returns.